It's a beautiful July day in Trussville, Alabama, and for whatever reason, well, I know why. I'm proud of my community. For the past 6 weeks, those that have you been watching these videos, we have concluded our COVID comeback series and had the opportunity to sit down with some leaders here in this community, which again, that is my sense of pride. This is a great place to live, and so I know viewers are all over the place, but I've been privileged to be able to have folks like that that are willing to help out in educating our viewers. So today we're going to turn the corner and talk about something that just happened today, actually. I had the news on this morning, and our Fed Chairman Jerome Powell was talking about inflation and interest rates and easing, basically economic stimulus. And I thought that it might be helpful for us to address some of that. You can turn the channel on, and I know some of our viewers are very financially astute. Some are in between, and some may say, I have no idea what that guy's talking about. So I was going to break it down into some very small snippets to help folks understand. I know, and we've done video series on this over the last couple of months, this idea of inflation. It is real. It is here. I do believe, and we've talked about this already, that some of the biggest causes of it right now are still the supply chain issues, okay? And so that's something that needs to be discussed and continued to be watched. But the reality is that the Fed Reserve they waffle back and forth. And I get it. They have access to a huge amount of data. Very much real-time information. They have their finger on the pulse better than just anybody else. There are a lot of smart economists out there, but their job really is to be the chief economist for the country, right? And so in that regard, they have waffled back and forth between raising interest rates, stimulating the economy, not stimulating this time, or doing it less. And today they've kind of waffled back again. It makes it a little bit difficult for you and I, right? For the common investor to figure out directions going forward. But essentially what he said is that they are still planning to raise short-term interest rates. Now, there's two ways the Fed can stimulate the economy. One, well, there's a number of ways, but the two things they're doing right now is keeping interest rates low, both on the long end, okay, so things that mature way out into the future, and things very short term. The way they stimulate on the short term, or keep interest rates low in the short term, is through the Fed funds rate. So the amount of money that banks have to pay to borrow money from the Fed to turn around and lend it to consumers, right? There's more to the story than that, but that's the short-term rate. They have basically said we're not going to do anything with those rates until maybe 2022, late 2022, early 2023. We'll see if that happens, but that's what they're saying. They're also stimulating the economy, and a lot of this happened back in 2008, 2009 with our last downturn, 2010. They started to pull back away from that, and then COVID hits, and they reverse course and they start stimulating again. And the way they do it on the long term is by buying their own bonds. So they go out and issue bonds, right? But now they're buying them back. So when the Fed buys its own treasury bonds out of the marketplace, that injects cash and pushes long-term rates down. So short-term rates are down, long-term rates are down. This is good and it's bad. It's good if you are trying to borrow money to buy a house. It's good, generally speaking, for the stock market. It's bad, however, if you are 60 plus years of age, retiring, trying to reduce risk in your portfolio, you're trying to produce income from your portfolio with interest rates as low as they have been, and they've been on a downward trend for 20 years now, but they are near rock bottom. It forces the more conservative investor to go up in their risk exposure, so to speak. So that's the bad side. What I would tell you is that if you're expecting a rise in interest rates, either short-term or long-term, in the near term, it's not going to happen. It doesn't look like that's going to happen. And so the Fed is still stimulating. They're basically claiming that unemployment isn't where they want to see it. And even though we have inflation, they want to see inflation for a longer period of time. The Fed, believes that this inflation that we're seeing is what they call transitory or short-term. I don't know if I quite am convinced of that. Richard and I have had some conversations. We listen to a lot of smart economists. The time will tell if truly this is short term. I will tell you clearly We are operating in new territory, and so this is a grand experiment. My point is just keep your eye on the ball. I will always try to interpret and make things simpler, bring them down into layman's terms for when you see things on the news. Until next time, Ian Maddox, if we can ever be of help, give us a shout. Talk to you soon.